Hello guys and welcome to another video. My name is Mark, I'm an entrepreneur and property investor. In today's video, we're going to give 5 reasons why everybody should be investing in property in 2023. Now, obviously I know not everybody can, but I believe everybody should. And if I start from that perspective, then at least hopefully the information that I give out will be useful for people who are watching this channel. At the end of the day, the people who choose to watch this sort of content are always going to be the sort of people who are going to go out, create, invest, become more. So I'm really excited about sharing my ideas about why 2023 is an exceptionally good time to be investing in property. Now, if you don't know who I am, my name's Mark. I have got £3.5 million worth of property, and on that I've got about £1.4 million worth of debt. And that's important to say because part of the risk that's going on at the moment is with interest rates going up. So I want to make sure that I give that sort of perspective straight away, that I am involved quite heavily in debt when it comes to my mortgages. I've got about, not quite 50% LTV, but I've got a decent chunk of debt in there. And as mortgage rates go up, it does affect me. So I want to make sure that I'm clear about that throughout the video, because I think some of the returns, for example, we're going to talk about, the safety, people are going to question whether with rising interest rates that's the case. But I want to give my perspective, and before I do, I want you to know my position. So my first point on here of why everybody should be investing in property is you get paid twice. And I think that's pretty obvious when it comes to property. You have the rental side and you have the capital side. Now, if you think about stocks and shares or index funds, you have the value of the companies that goes up or down and the dividends that get paid to you. The same applies in property. You have the rental yield, the amount of money you get from your tenant, as well as the value of the property over time. Now, if you look at what these operate at, we'll go into returns in a minute, I think it's really important to understand that these don't necessarily go hand in hand. There have been multiple occasions where the capital has gone down and the rent has gone up. For example, 2007, 2008, property prices dropped significantly, so your capital appreciation was negative. Rental prices increased. So it doesn't run in correlation, and it's important to say that at this point, but you do get paid in 2 ways. And for me, over the long term, this capital appreciation, you cannot forget that. That is so important. Property that I bought in 2010, 175,000. Today it's worth nearly £500,000. Something I bought 5 years ago, nothing special. It was a new build. I bought it for 400k. Today it's 550. You know, there is so much money in capital appreciation over time, but not just because property prices go up, but also because money becomes worth less. And we will always live in an inflationary environment because it's essential for the economy. So if you accept that that's always been the case, it is likely to always be the case, then capital should work in your favor as well. Good returns. Now, when I say good returns, I'm not talking about stupid returns, right? And I always believe if it seems too good to be true, there's probably some risk you're not aware of. So if we look at the good returns of property, a single let, what should you be getting? Well, I would say anywhere from 5 to 10% ROI right now, cash on cash, is pretty good. HMOs, 15 to 25%. Service accommodation, remember there is lots of things in the news about that. At the moment there could be some legislation coming. In fact, I think it's a dead certain there'll be some legislation coming. 25 to 75%, I mean we're looking at big returns. Lots of people use rent-to-rent strategies on that long-term leases. I think those people need to really assess a get-out-of-jail-free clause when it comes to changes in legislation, because ultimately they are turning residential homes into mini hotels. I don't think the government's going to allow that forever. So in terms of capital appreciation, which is the other way that we get paid, so we've got our 3 methods of rent, if you like, although the last one would be, you know, guests paying you, so it's not traditionally rent. Capital appreciation, I mean, some people say property doubles every 10 years, 12, 15. If we said 6 to 8% per year, that would be a fair comment. And you've got to remember that that's not necessarily going to be every year. It's the same with the stock market. You look at the S&P 500, delivered about 10% over the long run. However, it doesn't mean it doesn't go down some years. It doesn't mean it doesn't do 20, 30% some years. But over the long term, that's the sort of capital appreciation you can expect. So these are really good returns, especially on the capital side, because remember, that's on the value of the property, not on the amount of money you put in. Now that does mean, and as soon as I said those words, I realized I have to give you the risk. So if you buy a £100,000 property and you get a 75% mortgage, you've got 75k of debt and 25k in. If the property doubles, the property now is worth 200, You only put in 25,000, your return is insane, right? It's a massive, massive return. However, if it drops, you can go into negative equity and end up owing on the amount of money that you've borrowed. Now, 25% in is a large amount. The largest crashes in UK history have been about 30. So you're pretty well insulated. But guys, you've got to be aware of it whenever you're investing in property. And when it comes to safety, I want to make sure that people understand as soon as you start using leverage, there is less safety. Now with safety, I really wanted to pertain to the fact that, first of all, it's insurable. So if anything goes wrong with the house, i.e. if it burns to the ground and your tenant destroys it, it's completely insurable. So you have an insurable asset, first of all. You have a history that goes back forever of people needing somewhere to live. And it is likely to be the case in the future. So there's a lot of safety around this, isn't there? That people, no matter what industries they work in, they're always going to need somewhere to live. So whilst a product or a service may become obsolete in the future, for example, the smartphone killed Nokia, people at Nokia might have been let go and lost their jobs, but they would have got another job and still needed to pay their rent. So it doesn't really matter. It's not like a company where your industry might be massively affected. The safety really comes from the fact that the population, if you look at it on a big scale, are going to go out to work, they're going to earn their money, and then they're going to give a third of it to you. I think it's something like a third on average. So they're going to give a third of it to you in order for you to provide accommodation for them. Now, what they do might change over time. They might have manual jobs in the Victorian times. They might have more technology-led jobs today. But what might happen in the future might be completely different. But the reality is, your service doesn't change, which is that of a landlord allowing someone to live in a space that's safe. So there's a lot of safety in that, I think, as an investment class. I certainly believe there's a lot of safety in it. The banks do some due diligence. You can have a look at the quality of the bricks and mortar. There's lots of stuff around the safety side of things. The next two on here I really want to sort of bunch together, which is you can be creative with the asset. So as I said earlier, you can do single lets, you can do service accommodation, you can do HMOs, you can be a little bit creative, you can start to put extensions on, add value. There's lots of stuff that you can do with property where you can be a little bit creative. You can get vendor finance, you can do lease options. There's so many things that you can do to be creative. But my number one thing on this why 2023 might be the best time is because it's negotiable. You get the opportunity when people are scared to negotiate the price. So let's say, for example, the property's up for 100,000, it's worth 100,000. Comparables have sold 3 weeks ago for 100,000. But this property, for some reason, maybe it's just decorated badly or whatever, it's just not going to shift because at the moment there's a lack of buyers. Well, it allows you to go in, solve that problem, and negotiate on it. And you can secure some discounts at the moment. We've recently secured a discount on about 120 grand property, about 15 grand, a really, really good discount. So I think today is a really good opportunity to start negotiating, and only when people are worried is this an opportunity. In the last couple of years, there's been no instances where you're able to negotiate. Property prices have gone in one direction, and quite often people are having to bid way above the asking price to get an offer through. I've heard of people going to open houses and there being 40 people there to look at them. Now, the buyers have removed themselves from the market a little bit, and that means you've got an opportunity to negotiate. That's not really available in index funds or anything else. The market dictates the value on those. Property, you've got the opportunity to be creative and negotiable. So guys, what are your thoughts? Why do you think property is or isn't a great investment in 2023? Massively interested. I will see you on the next video. Cheers for watching, guys. Subscribe if you haven't already.